Good morning. Welcome to Bazaar Morning Call. I'm Lata, and in the studio with me, Sonia and Anuj. And there is a reason why. This is also an unlocked trade. Look at the numbers. Rise in recoveries are more than the rise in new cases. That's very important. Let's pull up the new cases bar chart for you. And that, I think, is what is playing this unlocked trade. Look at that bar chart coming up for you. With each passing day, the number of new cases are falling. And I don't know if we have a recovery chart. I think we don't. But if you looked at the number of recoveries, they are rising at a rising pace. So what happens? The net number that you get as active cases is falling. And yesterday, it fell by quite a record, the largest number in the last 1 week, by 3,700 cases. If we continue with this, with more recoveries and less new cases, then a time will come when it is not even worth reporting. COVID will be off the headlines. And that is the trade that's getting played out. You're seeing all the, the airlines exhibition stocks. But it is not just that. It's just that everyone will buy more clothes, will come out, buy more shoes. So the unlocked trade is beyond just airlines and, exhibition centers and hotels. It is also ordinary consumption. And just to add to it, several companies over the last week who have been speaking on the channel, Titan, NMDC, all of them have been telling us that normalcy returns either second half or fourth quarter. The worst that anyone has told us is fourth quarter normalcy returning, and in fact fourth quarter would be better than the fourth quarter of FY20. We also yesterday reported to you that Nomura and Credit Suisse had shown us economic recovery charts, like the Google recovery, the Google activity numbers, the freight rates, petrol diesel usage. Some of them are volatile. August is not as good as July in some cases, but in many cases August is better than July, and that, my sense is going to tell us that the 11,400 is not enough. Logically, we should get closer to 12,400 if normalcy is only 9 months or 6 months down the line, because now we have something we didn't have at that time. We have liquidity. So there is every reason why we should nudge towards 12,400, but that's, of course, for a positional trader, Anuj.
Yeah, morning, Lata. And amidst all of this, let's not forget the dollar index has made a fresh 2-year low.
Yes.
Yesterday, it slipped to 92. And that is why Friday was a great buying opportunity. And that's what we spoke about, that, there are times when you just have to ignore the noise and respect what the markets told you, and you make a lot of money. If you bought on Friday and said, okay, I'm buying, I'll just keep a stop loss of, say, last low. Let's see if the market has to throw me out. And this market will keep giving you these moves. It will keep shaking you out. You have to stay in. This current bull market, apart from this COVID play, which is obviously on, is essentially a dollar carry trade play. It's an emerging market rally that we are part of. It's not as if, we are having our own rally.
Absolutely.
So that way, you should not forget that. This market's rally would collapse when dollar starts to rally, and starts to rally big, if it starts to, say, cross 95 thereabout. Having said that, this market once again respected the template, right? Buy the dip and forget everything else. And, even if you didn't buy the dip, you had bought at higher levels, you still are making money. But from the Friday low of 11,111, you are up over 250 points. I say 250 because nobody would have gotten at 11,111. That's impossible. But even if you got in at 11,130, 11,140, 11,150, you are making a lot of money. And every time you break out, the high of the market is at least 200 points higher than the previous high. So in that case, that unfinished business of 11,500 should happen, perhaps even 11,600. Of course, like you said, Lata, for positional trader, perhaps, most markets are going to all-time highs. Why shouldn't our market also go to all-time high? So that would happen. Just one last number, just to explain this dollar trade. Yesterday, there was 1,100 crores of buying by FIs in cash market. Some profit taking in F&O, but that's okay. I think the larger trend of the market is to buy on dips and stay with the trend. The trend is on the upside. You make a lot of money if you stay with the trend. That's the basic point. Sonia, good morning.
Hi, good morning, Anuj. Morning, Lata. And just to dissect those FII numbers a bit more, you spoke about 1,130 crores of buying in the market. There was 600 crores delivery buying in Reliance. There was 500 crores delivery buying in ICICI Bank and 400 crores delivery buying in HDFC. So the usual favorites, the blue chip names. But apart from that, there was also delivery buying in a lot of this unlock theme. So, Lata was referring to how the COVID update is very encouraging now. Active COVID cases in India have dropped by over 3,700 in the last 24 hours. The unlock trade has continued in aviation, cement and commercial vehicles. So Ashok Leyland, for example, after a very long time, saw 200 crores of delivery buying yesterday, and it was up about 10%. But Anuj, on this subject of how to approach the markets henceforth, and on the Bank Nifty as well, what should the approach be now? Because this is a story that's playing out, right?
Yes.
Or if it has played out already, one doesn't know. Is it too late to jump in now?
No, Sonia, I want to dwell a little more time on the Nifty versus Bank Nifty move. I spoke about it yesterday as well. But look, what the Bank Nifty did yesterday, it was up 2.2%. The Nifty was up 1.2%. That's because the Bank Nifty had shorts. Even despite the rally, this month, actually, the Bank Nifty is underperforming. 2.4 compared to 2.8% for the Nifty. This year, the Nifty is down 8%. The Bank Nifty is down 32%. Now, why I keep dwelling on this point is that if you are a near-term trader and you want to play for short covering, perhaps the Bank Nifty still has more shorts. And led by HDFC Bank, which actually started to move up yesterday, there could be some more short covering on the Bank Nifty, and a near-term shakeout of the Bank Nifty bears is possible. But in the larger scheme of things, the banks are no longer the leaders, and the Bank Nifty is no longer the leadership index. That leadership has well and truly moved on to some of the IT, pharma, and auto names. All these names which auto ancillaries, all these kind of stocks where you will get more bang for the buck. But if you're a compulsive trader on the index, perhaps the Bank Nifty in the near term could offer some more short covering. But the larger moves are happening in the broader market.
We have to recognize that the Bank Nifty also has problems. I mean, ultimately, HDFC Bank also has the highest amount of retail loans. And this is the first time in Indian history that retail loans also are eligible for restructuring. So let's be, today there are some CMIE numbers that 50 million people lost jobs or I think is it 50 lakh, sorry. 50 lakh people lost jobs in the last 5 months. So, I mean, there could be, loanees in that category. So we have to be a little wary of, all of us are champions that you should get a loan recast because it is not the company's fault. But the point is, every time you recast, you are an interest that should accrue to the bank is not accruing, is not coming to them. And therefore, the depositor is losing. The money, the freedom given to the borrower is coming at the cost of the depositor or at the cost of the shareholder who has to put in capital. So, we must recognize that banks have that problem, and which is why the Nifty Bank is under. For all the reasons that the other companies are doing well, the Nifty Bank will not do well because it is taking the load of the, the bad work, the burden.
Okay, well, for now, the SGX Nifty is indicating that the start will be in the green. So we have lots to cheer about, especially after the big run yesterday. But let's get you some market opinion, the best and the brightest minds on Bazaar this morning. On the equities front, Neelkanth Mishra of Credit Suisse has a very interesting note. He says that after 26% drop in the FY21 Nifty earnings estimates and a 17% drop in FY22 estimates during the Q4 FY20 results, Q1 FY21 saw just a 6% cut for FY21 estimates and a 2% cut for FY22. So the cuts have come down. Neelkanth says that FY21 at a 7% growth year-on-year now appears reasonable, but still implies a 19% year-on-year growth in Q2 to Q4 of FY21, and we still fear it has downside. The entire growth is expected to come in from the banks, with ex-bank revenues assumed to dip 11%.
Okay. Well, Neelkanth adds that the bigger risk is with the FY22 EPS estimates, where the assumptions are more broad-based. The key risks would be with discretionary and energy, where they hold their underweights. Credit Suisse also maintains their cautious stance and stay overweight on IT, larger banks, staples and pharma. Neelkanth wraps up by saying that the Nifty may stay supported because of excess liquidity.
Okay, let's focus on the money markets now. By the way, the rupee ended at a one-month high against the dollar yesterday at about 74.77. Kunal Sodhani of Shinhan Bank India says that the state of political disarray is highlighted with nothing on the US fiscal stimulus yet, And with the US once again poking the dragon as game for presidential elections is under play. Dollar index hit a 27-month low. Gold glitters and Asian equities look firm after S&P 500 hitting an all-time high. The rupee is expected to trade in a range of 74.40 to 74.85 for the day.
More strength for the rupee, and that's obvious because of weakness for the dollar. Dhaval Dalal of Edelweiss says there are palpable signs of nervousness in the bond market after the recent spike in CPI and first devolvement of the government bond auction. Movement in OIS, that is overnight index swaps rates, suggests that market participants are scaling back rate cut expectations. All eyes on RBI to step in at some point and show support through an OMO bond purchase announcement. He expects yields of the 10-year bond to trade between 5.96 and 6% in the near term. Bonds are inching higher. Bond yields are inching higher.
Okay, let's talk about the global cues. The big theme, of course, has been a decline once again in the dollar. Here's Nigel with the world view.
Well, it was a good trading session for the US markets. The S&P 500 hit a fresh all-time high and they've gained nearly around 55% since the lows that we saw in March